Well, hello everyone, and a warm welcome to my portfolio update section. This was the last session actually of the day on our masterclass, and I'm recording it for you now if you were unable to be with us, or indeed if you found it so exciting that you wanted to listen once again. Now, this is always a really important section for our masterclass. It's the thing we use to sum up. Normally, each year, we're looking at one or two particular headwinds or problems or challenges that we're able to explain to our clients. This year's masterclass presented me with a real challenge because we're trying to wrap up lots and lots of bits of spaghetti, all the different things that are going on in the world right now. And so I tried my best throughout the day, actually, to position this section in such a way that we were able to, first of all, concentrate on the things that are wrong, the things that are a bit worrying, and then to concentrate on the positives, the things that we can see, the data that we're receiving that's giving us reasons to be cheerful going forward. So, first of all, with no further ado, let me begin with our portfolio updates. Now, you'd be forgiven for having a face a little bit like this poor chap as you look at your portfolios right now. Back last year, towards the end of the year, we were all celebrating being in a very, very strong position. And in fact, the Thomas & Thomas ethical portfolios and the mainstream portfolios were in such a great place, having really weathered the storms of the pandemic, not falling as far as the markets, and then getting the upside of the markets as well. It was really, really icing on the cake stuff. Since then, we've seen things going down. And really what I want to do is explain, firstly, what on earth has been happening. This is a picture of the Nasdaq index in America. Getting my words in a tangle there, sorry. The Nasdaq index is just one of the many indexes in the US. But it's an important one, alongside indexes that you may have heard of, such as the Dow Jones or the S&P 500, which is their top 500 companies. This one's a bit different. This one actually is more of a tech index. The reason I've chosen it to show you a little bit about what's going on is that it includes a lot of the big global players that we don't have here listed anymore in our London Stock Exchange. So here on the Nasdaq, you can see things were nice and rosy as you come up at the beginning of a year ago, if you like. So July, August, September, October, November, it was rising beautifully. And then literally we come along to January the 1st almost, 2022. And it's like the whole world woke up to the fact there was an inflation problem. Now, many of you, as my clients, will have remembered that I was fretting about inflation way back in the pandemic, when quantitative easing was being relaunched. And it wasn't that quantitative easing is a bad thing, but the worry I had is that central bankers tend to have a bit of an inclination to overstretch quantitative easing. We know that this can create two problems. The first thing is it can create rampant inflation, but the second problem is that it can actually create great inequalities. So the people who've got assets tend to see their asset prices being pumped up, and the people who haven't got them tend to see it's even harder to get onto things like the property ladder. So here you can see the world waking up to the fact that inflation was flying through into the markets. Why did the Nasdaq drop so dramatically? I mean, it's down about 30% here, as you can see at the last reading. The reason for this was that effectively, these types of companies are really, really good quality, good growth companies, as we would call them. So you've got companies in here like Microsoft, Apple, Amazon, Netflix, Google. These companies are companies that have very, very robust models. They have considerable amounts of cash behind them, and they're not doing things that can harm the planet or the environment particularly. Therefore, they're a bit more future-proof. And so they're good growth companies. Now, if you're running a company like, I don't know, Microsoft, just for example, not as a recommendation, if you're running that company, are you really going to want to pay huge dividends out to investors? Well, probably not, because really, in honesty, you're going to attract investors because of your strength of your balance sheet. You're in great condition, and therefore, why do you need to pay huge dividends? Whereas, if you are, for instance, an oil company or a tobacco company, you may well pay much higher dividends because you want to attract investors as investors have been starting to shun you over the last decade or so, as they don't want things that maybe harm environment, maybe harm society. And so your business model may not be quite so future-proof. What happened here, right back at the beginning of this year, was a sudden real sell-off in this particular territory, where investors started to sell good quality growth stocks and go out and buy the kind of high yielding, high dividend stocks that probably aren't quite so future proof. And so we saw the FTSE 100 here in the UK, which is chocked full of those sort of high yield, high dividend, poorer quality stocks going up or staying the same. And we saw indexes such as this one in the US crashing down. We saw this as a global picture, actually. Most indexes did crash. This one particularly bad, and you can see the damage. So what we really have to ask is, where's this all coming from, this inflation problem, as investors desperately seek higher dividends to try and keep up with inflation and start to throw out a lot of good quality investments? And is it just happening here in shares? Well, no, sadly, it's happening in the very things that we would normally have to defend against equity falls. Now, you would look at this chart at first, possibly, and be forgiven for being excited that the line is rising. However, this is really bad news for things such as bonds. Now, this is a chart of the US 10-year Treasury yield. And what it shows you, very interestingly, is that about a year ago, if the US government wanted to borrow money, they could sell treasuries into the market and they would have to pay just over 1.5%. If they'd then, a year later, been trying to sell these treasuries into the market, they'd now have to be paying about 3.5%, so a rise of nearly 2%. What really this means is that if you were an investor who had held one of these very boring investments, they're deliberately designed to be very, very steady, low volatility. If you'd bought, for instance, a $100 US Treasury 1 year ago, and you're getting 1.5% on it, and now your friend comes along and buys a $100 US 10-year Treasury a year later, they're going to get 3.5% on theirs. Well, your interest rate can't rise because these are fixed interest securities. Governments need to know where they stand. They're not going to say, well, I'm very sorry that your inflation's rising. I'll tell you what we'll do, we'll give you more interest. No, it's fixed. It's fixed for 10 years. So to that end, there's only one thing that can happen, and that is that your treasury that you're holding from a year ago goes down in value, and down in value quite dramatically. Let's have a look at the UK gilt market. So this is the UK gilt market. This is exactly the same kind of picture, in fact, probably worse. The UK government, under a man you may have heard of called Rishi Sunak, I know, do you remember him? He was basically able to go out and borrow money, look, at about 0.5% a year ago, just over. Fantastic. Cheap as chips. What's happened in 1 year is that he, or now his predecessors, have to pay over 2.5%. And what this means is that the markets are pushing up what they want from a gilt. They want more and more yield. Why? Because of inflation. And so, the same scenario. If you are holding a one-year-old gilt that's got 9 years left to go, you're getting about 0.5% interest. Your friend comes along, they buy the same thing. Today, they're getting 2.5%. So we completed our modified duration calculations. Actually, about 2 years ago, we started getting a bit twitchy about this, and we were certainly looking at this again about 9 months ago when we got rid of gilts from clients' portfolios and we reduced bond exposure. And at that stage, what we were seeing was about an 8% projected fall for every 1% rise in gilt yields. So to put that sort of into numbers, we're not really surprised if we're seeing 16% falls in gilt prices, which is absolutely radical. I mean, that's terrifying because gilts are supposed to be steady and boring, but because they've been pushed up by quantitative easing, this is what we've seen is this kind of incredible price but very low yield. Suddenly, it's flipped on its head. Now, before I go any further, I just want to offer some reassurances. Over the last 10 days, we've seen gilt yields and US Treasury yields really shifting downwards again. That's great news. It means the markets are starting to sort of think to themselves, just maybe interest rates aren't going to carry up and up and up. And maybe, just maybe, central banks have got a bit of a handle on inflation at last. But who's the culprit here? Well, let's have a look. Now, the media are probably telling you that it's this fella. That's it, ladies and gentlemen, Lord Sauron of Mordor. Here he is, it's him. Everyone's blaming Mr. Putin and Russia. Now, certainly, I believe Russia have been opportunistic. They've seen the weakness of the West. They've seen how we have literally failed, I suppose, in many of our policies. And as a result, they have taken the risk and invaded their neighbour. And in doing that, that has definitely, I'm sorry to use this analogy, but it's thrown petrol onto the flames of inflation. So they haven't helped. But I don't believe it's so much started with this gentleman. I believe if you really want to see where this inflation problem has started, I would suggest they're in the next slide. So these two gentlemen, who are these very, very honourable fellows? We have got at the top Mr. Jerome Powell, the head of the Federal Reserve in America, the American Central Bank, if you will. And underneath him, the very esteemed Mr. Andrew Bailey, who is the head of the Bank of England, central banking again. So you've got both of them, very, very well experienced gentlemen with experienced teams. But in honesty, I believe this is what has fed inflation. Can we blame them? Well, let's just cast our minds back and be fair. If we go back a couple of years ago, March 2020, I remember it well, it was a very painful time. We were watching as the global governments decided to conduct an experiment. It was an unintentional experiment, but it was nonetheless an absolutely outrageous experiment, and that was to lock everyone in their homes. Now, they needed to do it, but in doing that, they effectively unplugged the global economy from the wall. In doing this, what we saw was assets falling through the floor. If you looked at equity prices at the time, all the markets globally, if you looked at house prices even as well, they were tanking downwards. And we saw equity prices falling at a fastest rate than we'd ever seen historically. I mean, it made the 1929 Wall Street crash honestly look like a walk in the park. This crash was horrendous, and many of you were with me on it, and we saw it through. But that crash was accelerating at such a rate that these two gentlemen had to do something. And so they reached for their 2008 playbook, and they resurrected quantitative easing. Now, quantitative easing is designed to try and stave off a central banker's second worst nightmare. And a central banker's second worst nightmare is deflation. You only have to look at Japan in the 90s and the noughties and how they suffered with deflation. Now, deflation means that a person who is thinking of buying perhaps a new car or a washing machine or anything thinks to themselves, well, there's no point buying it today. I'll wait till tomorrow because it'll be cheaper. So deflation's a nightmare. And what certainly the central banks in America and Britain, and to an extent in Europe, wanted to try and stave off was this massive reduction in asset values. And so they resurrected quantitative easing, and they cut interest rates really as low as they could. Certainly here in Britain, we didn't have much headroom as interest rates hadn't been risen, probably when they really should have been under the previous Bank of England governor, who I believe really didn't do what he should have done. So where we are stuck here is a situation where really Mr. Bailey and Mr. Powell had to bring in quantitative easing. Now, what is quantitative easing? Let's have a look at this. This is my pinched slide. It's quite useful. And it just shows us how quantitative easing works. Now, I know for many of you, you probably grasp this, but let me just chat you through this to be sure. What you've got at the top here is that big building with an American flag on the top of it. That represents a central bank. Now, it could be the Federal Reserve in America, it could be the Bank of England, the ECB, European Central Bank, it doesn't matter. Imagine, if you will, that the central bank sees the need for more liquidity in the system. They are terrified of deflation. They're actually terrified of recession, and they're worried that there's not enough money in the economy. Now, in my analogy, imagine, if you could, perhaps a hose pipe, and the hose pipe has reduced to a trickle of water coming out. This is the central bank's method of basically turning a tap on full so that water comes gushing out and it sprays all around the economy. What we call this is widening the money supply. It's where more money is pushed into the economy, and so people feel richer and they feel more inclined to go out and buy daft things they probably didn't need, and such as Bitcoin or even perhaps, I don't know, a three-piece suite they didn't really want. And so these things help to turn the economy, and you get this trickle-down effect. This is how they do it. They pump cash into high street banks. That's the high street bank underneath. Again, forgive the American slide, but it's the best one I could find. And it shows you a high street bank with the dollar on it there. So imagine perhaps for us it might be a Barclays or an HSBC or a NatWest or so on. They push cash into that high street bank in return for bonds and equities from that bank. So effectively, the central bank enters the marketplace as a giant buyer, a huge buyer. It changes the game, because what it means is suddenly they're buying up rafts of bonds and equities. Not a bad thing, of course, when bonds and equities are on the way down, but the trouble is they keep buying as they come on the way up, so they're starting to buy them at quite an expensive price. This, in turn, should mean that the high street bank is now awash with cash. They've got rid of the bonds and equities, they've got lots of cash, and they should then be motivated to lend that cash to the likes of you and I, for us to perhaps buy our homes or our cars or whatever. Or it could even be for smaller businesses like ours to maybe expand or grow. And so that's how it works. That's the idea. Now, of course, the problem here is that in doing this, if the central bank isn't careful, they spray too much water, if you will, too much money into the economy, and they soak it. And as a result, you then get rampant inflation. And ladies and gentlemen, that is the biggest nightmare for a central banker. It beats deflation. And it's where they then can't stop the money flying around the money supply, around the system. And so you get more and more inflation coming through as workers start to demand more wages. And you get this sort of push-up effect, which is incredibly hard to stop. That's what we saw. Personally, if I'm being honest, I wish that certainly here in the UK, as I say, pre-Andrew Bailey time, I wish we'd seen a bit of a raising of interest rates. I also wish that either interest rates have been risen or QE have been stopped off back in the summer last year. But that's with the benefit of hindsight, right? At the time, we were in a position where we didn't know if more lockdowns might be coming. It was incredibly hard for central bankers. In fact, I believe this picture, taken from the China Daily, is a beautiful example of how global central bankers were running away from the COVID monster. There it is in the background with a knife, a horrible little creature. And really, that's what global central bankers were terrified of. They were really worried that they couldn't get this thing under control, that the global economy was going to be unplugged from the wall again. It was very, very stop-start. We had supply chain issues. It didn't look good. The trouble is, these central bankers, bless them, they were unable to see what was awaiting around the corner, I think. And that was, if you can see it there in the dark shadows, the energy crisis. Now, really, the energy crisis is the thing that's probably hit us all a little bit from left field. What we have is a situation where inflation's been rising at the very time that we've been running short of energy. Let me give you an example. Back in September of last year, really quite unreported, was the fact that China were struggling with their sign-up to the carbon emissions or CO2 emission targets. Now, this is something that politicians around the world, in absolute honesty, they've been terrified of the sort of climate emergency protests, and they have really signed up to targets that are incredibly ambitious if they are not really on it. And China is a really, really good example of a country that was trying to do its best, actually, to perhaps meet their target, but where things failed. And let me share this with you. So back in September last year, China were desperately trying to get rid of their coal-fired power stations. In the south of China, they achieved it. They closed them all down and they replaced them with a really, really extensive project of hydro dams. And these hydro dams were responsible for 30% of China's electricity supply. So far, so good. They then looked at the north of China and realized they still had too many coal-fired power stations running and that they were going to not meet their CO2 target for the end of the year. And so they cut off, or they shut down, some of those power stations in an attempt to meet their target. Then they suffered an incredibly hot summer that September of 2021, not so long ago. As a result, the rivers dried up and the hydro dams stopped working. Consequently, that electricity supply that was coming from the renewable source stopped. People then, of course, all turned on their air conditioning, and so, to use the phrase, the lights went out. There were blackouts all across China as electricity stopped. I believe this is a really, really good warning for us in the West, and probably something we will encounter more because we haven't prepared properly. So here in China, they faced a massive crisis. They couldn't allow, do nothing. And so they met, and the Chinese government apparently said something along the lines of, well, I tell you what we'll do, we'll take the cap off on the energy costs, so we'll stop subsidizing it. And you know what? Let people experience the real true cost of burning fossil fuels. Sounds very, very, it sounds very good, doesn't it? It's quite admirable, really. So they did that. And as a result, the Chinese people got very angry because they couldn't have their air conditioning on and it was swelteringly hot. The Chinese government looked at this and thought, do you know what? We're in real trouble here if we get to the winter and this problem exists. People might be a bit angry when they can't have their aircon on, but we're going to really lose control here if they're dying of cold in their houses in the winter. And so they went out and they bought up pretty much all the world's supply of liquefied natural gas, LNG, which is highly transportable. They bought it up, and so they put massive pressure on world energy markets right back in September, October last year. That's what drove this energy crisis. Here in the West, we've been sort of trying to catch up. It's quite well reported that we don't have plans in place for replacing our coal and nuclear stations, and so it's a bit of a problem here as well. And I think this is really a bit of a glimpse into the future, and hopefully just shares with you really some of the problems that we've been sharing. So, after all that negative news, and really trying to help you understand where we've been and why this energy crisis has come along, I wanted to ask the question for you really, is it still worth it, Darren? So I know that many of you watching this will have been clients of mine for many, many years. And for you, you're probably quite aware of the fact that we do go through these really nasty falls and then we see the bounce backs. However, if you're newer as a client, then I would love you to just have a look at these charts. We've got here 3 portfolio examples. This is an exact replica of our level 2 portfolio. As you know, from 1 to 5 on our risk scale, our level 2 is a more cautious portfolio. And the green line is an exact replica of that level 2 model. Now you can see some dots on that green line, hopefully. Those dots are where we've been proactively making changes to the portfolios to help tweak them. So this shows you kind of the old things and then the newer ones coming in and then the changes. You can also see a red line underneath it. Now there's a bit of a straight flat line at first and then it gets going. And this is just because the FE info doesn't pull through the volatility in that first year on this tracker that we used. It's a FTSE 100 tracker. Nonetheless, the actual numbers that run, they are correct. And so you can see the level 2 over 10 years beats the FTSE 100 tracker, which is really good going when the level 2 is designed to be slightly less volatile. And you can see how much less volatile if you look at that pandemic drop, which is if you see it after December 19, you come into 2020 and there's that huge fall off on the red and the fall in the green above it. The green doesn't fall as far, which is a help. So that's one part of good news. But the other thing is you can see that you've had around about 67% growth over 10 years on that level 2 portfolio. Now, all right, if we'd looked at this a year ago, that would have been considerably higher. And indeed, when I prepared these charts for the masterclass, you can look at the date range. We're already getting on for nearly a month ago. Markets have improved since here, and so the figures would look even better. What's important, though, to say is that the past is not always a guide to the future, and you might not get 67% over the next 10 years. But you know what? I'll take that. That's an annualized return of 6 or so percent over 10 years. I'm happy with that. It's simple to show you it this way, but hopefully it helps you have some encouragement. What about our level 3? So for our level 3, we picked an ethical portfolio just to mix it up. You've seen a mainstream, which has got kind of oil in it and tobacco and so on. Here we've got a level 3, which doesn't have those things in it. And again, a positive picture over the 10 years. You can see that line there getting a little bit spikier. That's because it's taking a bit more risk. You can see those green dots again where we've made adjustments. And you can see that it comes in at about 110% over 10 years. Again, no guide to the future, but these charts taken about a month ago as well. Markets have recovered a bit since then. So again, I'm pleased with this. This gives me encouragement. It reminds us, doesn't it, as to why we're doing this. Now, I do want to comment on something else on this chart, and that is if you look towards the end of the green line, look at the fall, and you can see the fall as against the FTSE 100. Now, you'd be very forgiven for thinking, and I would agree with you here, that you'd probably be better off over the last 6 months, certainly, you would have been better off by just holding UK funds, perhaps some UK trackers, very easy, and you would have done better. But because this portfolio is a global portfolio, it consists of many different equities in the US, Europe, Japan, Asia, and so on, China and so on. You've seen a sharper fall. And that, it still means that over time you're better off, but that is quite noticeable in the short term. We believe we're on the right tracks. We're not changing our strategy, and I'll show you why in a minute. Now, this is our level 4 portfolio. It's the last one I'm going to show you today. Again, over 10 years, exactly the same data. You can see the green line, you can see the changes we've made, you can see the recent fall, but you can see how over 10 years, it's still coming in at about 120% growth over 10 years. So I'm very, very pleased with that. That's certainly fine. And again, we've seen some quite big improvements actually recently on that. No guide that that's going to be exactly what it'll do in the future, but it gives you some encouragement that doing this is a good move over the long term. Yes, it goes down, but look how it comes back each time. So, okay, that's enough on our portfolios. I'm going to finish with a few slides that I really love to talk about. So the first one here, we've got 4. The first one here is very, very quickly, just to look at a bit of a clue on some encouraging data. This is the Shanghai Index, China, second largest economy in the world. And really what you can see is they have been through that massive crash, just like America. Look at it go down. Down it goes, down it goes, down it goes. But unlike America, they started to pull back out of this about a month ago. And we've been watching this with great interest and excitement. And look how that blue line is coming up and up. That, ladies and gentlemen, is very encouraging. They're pushing more liquidity into their markets. They've turned QE on. So they've turned their quantitative easing on at the very time that here in the UK and in the US, central bankers have been turning it off. So you're seeing China recovering fast. That will help really drive portfolios. And that's very, very good news. The second slide I want to show you here is borrowed from Quilter with their permission here. And it shows you the past 30 years of investment journey. And this is a brilliant slide. And there's 3 things I really want to pull out of this. So before I do that, let me just talk you through the slide so you can understand it. If you imagine back in 1992, before even the Spice Girls came along, you would have been perhaps here with £10,000, you can see to the left of the chart. If you'd put your £10,000 in the bank and had a UK base rate as your interest rate, you would today have £26,325. If, however, you'd gone for those gilts and those bonds, those treasuries that we were looking at earlier on, and you'd invested into those for 30 years, well, look at the orange line and the blue line. You can see they're smoother than the other lines above them. You'd have come in at about 59,000, according to the research done here by Quilter. So a nice gain with fairly low risk. And that's really what we're trying to achieve in our level 1 and 2 portfolios. Then you come up to the silvery grey line, which is UK equities. Look at that. You'd have gone from £10,000 up to £95,936. Very, very encouraging. But look how much more spiky the line is. And here's really my case in point. The top one, the green line, is global equities. If you'd had a portfolio that consisted of a bit of everything, you know, some China, Japan, US, Europe, Britain, you'd have seen a much bigger growth, something like £140,000 over the 30 years. So what are the observations I'd like to pull out, other than encouraging you that, yet again, having a global asset allocation, a mixed portfolio, is a good move. Oh, and by the way, look at that. You can see at the end of that global equities line exactly the same thing happening as your portfolios, that recent fall off. But we're not concerned because we know this happens time and time again. So what are the things I'd like to pull out? Well, the first thing is this. Look at the amount of crises that have happened, those grey little notes along the charts. If you go right back to the beginning, you've got Black Wednesday, then you've got that first Russian financial crisis, Asian crisis, you've got the Twin Towers attack, you've got the dot-com bubble collapse. Anybody remember the millennium bug? You've got the global financial crisis of 2008, 2009. You've got US debt ceiling crisis in 2011. That was a big issue. Loads of different the trade war between China and America, and you can see that. Then the pandemic. You can see that sort of dip there. Look in 2020, that nasty dip. So these crises happen. They come and they go. And every time you're in a crisis, you think at the time that this is much worse than all the others. But really, genuinely, over time, it will prove to have not been. It's just another sell-off and then another frantic buyback. And that's the other thing I really want to point out on this chart. And that is, look how after every dip along that green line, you can see a recovery. And look how it bounces back. And in fact, I'd like to point another thing out within this. If you can look carefully, you'll see where the drop is shallower, so where it's not quite so steep, the recovery takes longer and it's slower. Where the sharp is very, very dramatic, the snapback is also equally dramatic. And that's something to give us real encouragement here with our globally exposed, diversified portfolios. Okay, 2 more slides to show you then. So, sorry, I've lied. 3 more, sorry. This one's just a quick example. Again, imagine you'd invested £1 back in 1900. Now, I know that many of you are in great health, but I'm not advocating a 120-year investment plan here. However, I love to go back as long as I can because I always think it shows you the truer and truer picture. And look at this. If you'd put £1 in, this is from JP Morgan, this one. Thank you, JP Morgan. You've got £1 has been invested for 120 years in cash. Well, allowing for inflation, it would now be worth £2. If you'd invested into bonds, you can see how £1 invested into gilts and treasuries and corporate bonds and so on would be worth now about £7. And you can see that line has a bit of a move around. And then you've got the equities picture. That's the global, the MSCI global index. You can see the big rise and coming in at about £420. So again, just illustrating my point, time in the market, in equities, very, very valuable. That leads me on to my second to last slide. Now, I love this slide. This has been prepared by Columbia Threadneedle. I've seen other ones like this over my career, and they're always encouraging. It's not just a one-off. This I have entitled Time in the Market, not Timing the Market. You see, over my 28 years or so of doing this job, I have been hit with the constant question of, well, can we wait until the market's better and then invest? And of course, by then you've missed that growth. Indeed, markets don't work in a linear way. You don't get that kind of steady growth. What you get is very erratic gains that are often only over a short space of a few days before they level out again for a while. And so you've got to be in it to win it. Now, what Columbia Threadneedle have done here is they have looked at the US S&P 500 index. That, if you recall, is the top 500 companies in the US. And what they're showing you here is how, if you put your money in the S&P 500 for, let's have a look here, I think it's from 1989 to 2021, so well over 30 years. If you'd invested for 32 years here and left your money and gone through all the dips and all the gains and not touched it, you'd have had an annual return of 10.8%. Well, I'll take that. That's lovely. However, if you'd just got a little bit panicky and you'd taken your money out for just 5 days over the 32 years and you'd missed the 5 best days on the S&P 500, it dramatically affects your return. That then falls to 9.2%. If you missed 10 days, it would fall to 8.1. If you'd missed 20 days, just 20 days out of 32 years, that's less than a day a year, you'd be down to 6.3. And indeed, if you'd really missed out on just 25 days, 25 of the best days on the S&P 500, you'd have gone from 10.8% annualized return to 5.6%, which is really frustrating because what you'd have seen is you'd missed almost double, really, the gain if you'd only just held it. And so this is a good lesson in holding your nerve, but also in making sure you're in the market, because otherwise you will miss those rapid recoveries when they come. So this is my last slide of the day to show you, my last chart. I love this chart. It's really, really fascinating. Borrowed again from JP Morgan. And at first it looks confusing, but do you know what? It's really straightforward. What we've got here is a grey line at the bottom, and that again is the S&P 500 index. You can see it coming along the bottom of the chart and then rising. So a lovely growth from 1995 all the way through to 2022. You can see those ups and downs, sharp falls, sharp recoveries, sharp falls, sharp recoveries, and you can see it growing. Now above that is what we call a volume index, and it shows you the amount of purchases or sales of what they call mutual funds in the US. So in America, they don't call our CIAs, collective investment accounts, and ISAs, they don't call them that, collectives, they call them mutual funds, but it's the same thing. And I just find this chart brilliant. It's what I call my sheep chart, because look how it shows you how when the market's rising, everyone's buying funds, and then in those red bits, where the market's falling, everyone's selling funds. So they're basically following the market, and in fact, they're probably talking to each other. You know, you're talking to your friend down the pub who's saying, oh, it's really bad right now, you need to sell before you lose everything. And so they're selling when the market's fallen, making a big loss. And then, of course, they're talking to the same chap down the pub or uncle or auntie who's saying, oh, great time to buy, mind. You know, it's gone up a lot. And so they're buying after it's risen. This is really fascinating. And I do love the fact that our clients do work with us, they do listen to us, and they give us a chance to help them really stop this happening. And I believe that's why our clients do so well. It's not that we're particularly clever or magicians or anything like that. It's because we stick to these fundamental understandings gained through studying the markets over time, that you want to be careful when markets are falling, that you're not selling at that point, but that indeed, if you can, you're buying or you're at least holding. So that was the conclusion of our presentation. I hope it helped. Now, I asked people for questions on the day and I had loads of them. I have no idea what this little animal is, I just liked him. Really what I'd say is, if you are watching this presentation and it has thrown you up some questions, then please give us a call, give us an email, and I'll try and answer it for you. Phone calls are probably the easiest, but if you prefer something that we can pen in email, I will gladly do all I can to help. I hope you've enjoyed this, and thank you for putting up with me, and I wish you all the very best.